Good evening, everybody. Welcome to Quantum Mutual Funds Mega Webinar. We have our panel of our fund managers with us today. The topic for today is overcoming how you can overcome short-term downside risk with a long-term portfolio. We have a panel of our fund managers. You must be already knowing our fund managers if you have attended our previous webinars. Myself, Sandeep Bosle, I head the customer interaction team at Quantum Mutual Fund. I will just give a brief about our fund managers. We have Chirag Mehta with us. Chirag is our CIO. Chirag has joined Quantum in 2006 and has around 19 years of experience. We have Sorbh Gupta. Sorbh is the fund manager for equity. He handles Quantum long-term equity fund and tax saving fund. We have Pankaj Pathak with us. Pankaj is the fund manager for fixed income. He manages our Quantum dynamic bond fund and Quantum liquid fund. Pankaj has over 12 years of experience. And we have Ghazal Jain. Ghazal joined us in 2019 and she manages our equity fund of fund. Yeah, so we will have a short presentation for around half an hour, around 30-35 minutes. We have already received some questions from our investors. Any questions you would like to ask, you can type in the chat box. We will ensure that we answer the last question. Yeah, over to you, Chirag.
Thank you, Sandeep, and thank you everyone for tuning in today. I know what we are seeing in markets is pretty dynamic. We are seeing markets correct, and this has been some meaningful correction after a long time. Post-COVID crisis, which led to markets sliding down about 40% in that month of March 2020. This is again a time when we are seeing markets correct, and investors will undoubtedly have more questions in terms of how do they overcome these downside pressures that they're seeing? Are they allocated in the right manner? What are the views on asset classes where they should be positioned? So from that perspective, we'll run the asset class views for you. First, we'll run you through some macro backdrop, what we are seeing in economy and the global markets. Then we'll run through asset class views of equity, debt, and gold. And lastly, in terms of how you can, build a robust portfolio that will help you minimize downsides whenever it occurs. So with that, I will run through a few slides on global macro. So if you look at the uncertainty out there is significantly large, and it's been continuing since some time. If you look at global commodity prices have gone through the roof, be it food, be it energy, crude oil prices above $110. Even the agricultural commodity prices have gone up significantly. This has forced central banks to increase interest rates and remove the accommodation that they had since COVID crisis. So what policies that they ran, they are kind of unwinding those measures and at the same time increasing interest rates because inflation is running at multi-year highs, be it in US, be it in Europe, or be it in India. So that is leading to the action on the central bank front. And like what we have seen usually whenever there is a dollar which is strengthening, whenever interest rates globally strengthen, we have seen foreign portfolio investors leave the likes of emerging markets like India, and this time is no different. Also, inflation is also impacting corporate profitability given input cost pressures for companies, and that is leading to lower profit, lower earnings, and that pressure is very, very evident and is reflecting in stock markets. If you look at earlier, central banks shrugged inflation, saying that, given that they had to support growth, they said that inflation is transitory. But now, if you look at the price increases, even this year, earlier they said there were supply side disruptions that were causing inflation. But now most of the economies have normalized, business activity has resumed. Still, we have seen good increase in commodity prices, be it anything like coal, crude, steel prices, likes of aluminum, zinc, etc. Even those prices have been increasing further. What has accelerated that inflation is also because of the Russia-Ukraine war, where supplies of certain commodities like crude, like aluminum, etc., or agricultural commodities have been hampered because of that. So inflation continues to persist, and with a very high degree of inflation over a year-on-year basis. So if you look at the Indian landscape also, we have seen inflation inch up above the RBI's comfort level of 6% band. They have a room of 4 to 6% is where they want to see inflation. but it's above that higher level of the band that they operate onto. It's above 6%, very closer to 8%. And what has driven this inflation increase, if you look at food and beverage, clothing, it's very, very broad-based, largely fuel and light, household goods and services, transport and communication. And this inflation can remain sticky. If you look at those red circles, is there where we can see some stickiness in inflation, given fuel and light. For example, electricity prices have not gone up, kerosene prices have not gone up. That will lead to further increase in fuel and light basket, and where we see more inflation coming. Household goods and services, as companies pass on the input cost pressures to consumers, that is where goods and services will also get pricey. And transport and communication, given the increase in crude oil, gas prices, transport costs could inch higher. Even on the communication side, like if you look at all the mobile phone towers, they work on diesel gensets, and therefore even their diesel cost will be an incremental cost for them, and that will also be passed on. So there will be some stickiness in inflation and may remain high, which will force RBI to increase the interest rates further. Pankaj will take on where we expect inflation or interest rates to go and where inflation is likely to be. If you look at globally versus India, global inflation has been significantly larger. If you look at US inflation, has been at closer to around 8% levels, and it's been inching higher, whereas India is gradually catching up. What has been a benefit to India? Because we had good food stocks. That is why the food inflation impact on India hasn't been large. Whereas for markets like US, Europe, the food price increase has been significantly large, and that has led to more inflation. If you look at the orange line, the price of cereals, YOY basis, they had gone up to 20-30%. Whereas for India, it has not even gone to more than 10%. So that has helped us shield much of the inflation pressures. Despite that, having said that, oil, etc., is still a burden on our economy. So look at the differences in inflation that we were talking about. US, if you look at last 10 years, has not seen inflation levels above 3%. It used to be between 0 to 3% largely. Whereas India, and in US, it's closer to 9% now. So it's a remarkable shift from 3% at the max to 9% now. And India, we have seen such high levels of inflation before. Our companies, consumers have seen such high inflation before. So at 6% level, it's not, or 7-8% level, it will not be a significant, because we have seen those cycles of inflation and we are used to that. But relatively, as compared to the world, India inflation is still subdued because of lesser impact on the agricultural front. And given that, given the impact of inflation on India is lesser, the rate hikes also may be not as high as what we may see in developed markets. They are at the zero bound. They are starting to increase rates. Inflation pressures are more versus India. And therefore, the central banks there will have to do much more than what India will have to do. Given that rate hikes may be gradual and not disrupt the pickup in activity that we are seeing at the ground level for sectors like real estate and IT, we are seeing a significant pickup in these two levers, which are driving growth in the economy today. So residential market, if you see, the sales have been increasing, inventory has been falling, and that is a result of interest rates remaining so low. If you look at from affordability perspective, which is nothing but EMI versus income ratios, they are at multi-decade highs, something similar to what we saw in 2002-2003 cycle. And given that salaries of people, incomes of people have been rising, the affordability has increased, which is likely to drive real estate activity for some more time. Also, on the other hand, we have seen IT sector gain significant momentum. There has been growth in the IT sector, which is leading to a lot of employment and better paying jobs for people. And that is also driving much of the economic activity in the economy. At the other hand, government spending is likely to increase. We have seen that what will support that is the higher tax collections, be it GST or be it corporate tax, income tax collections have been incrementally higher for the government. So we hope that government will kind of do the heavy lifting and try and make more capital expenditure, which will lead to increase in economic activity further. Impact of higher global interest rates. Whenever we have seen tightening, usually flows tend to move out, and this time is no different. If you look at 2022, we have seen outflows of about $16 billion. At the same time, local domestic investors have pumped in close to $12 billion, and that has led to lessen the impact of the outflows that we have seen for foreign investors. If you look at 2008 period, foreign investors nearly moved out $12 billion. Local activity was small at about $3 billion. And look at the market impact, minus 60% down. In the same period, in 2022, if you look at foreign outflows are much higher than what we saw in 2008. But at the same time, local activity is much larger. And therefore, the impact on the market is minus 4.5% versus minus 60% at that point in time. So higher local support, higher local buying has supported stock markets to an extent. So we think that Indian economy is in upswing. There was a cyclical recovery, which we think will continue, has been slightly delayed because of inflationary pressures that we are seeing, and therefore interest rate increases that will kind of have a small dent. But overall, we think that economy should be in an upswing. What are the risks to this cyclical uptick that we are seeing is if there is rising inflation and the SME sector goes through a bad phase, then probably consumer discretionary spend will also be impacted. If there is an extended war and it kind of disrupts supply chain, that is also another risk, because commodity prices will keep inching higher, and therefore more inflation and more reason for the central bank to act more aggressively. At the same time, if we have weaker than expected monsoon, even that could impact, because so far, if you've seen in the inflationary pressures, agricultural impact has been lesser. And if we have a weaker monsoon, then probably agri prices will also start moving up and lead to more stickiness in inflation and more higher uptick in inflation. So overall, we think there are still a high probability that economy will be doing better. The probability of these risks playing out is still lesser. So you should play or bank on a good growth that we could see in our Indian economy, or normalized growth in our economy over the next 2 to 3 years. So with that, I think though equity markets will be a better play on the recovery that we're seeing, we do advise, or we do recommend investors, not an advice, but recommend investors that they do diversify their investments across asset classes. And this 12-20-80 asset allocation strategy works really well irrespective of the market conditions that we have seen, be it the global financial crisis, be it the COVID crisis, or the up move that we have seen post-COVID. In most of the market scenarios, this allocation strategy works really well. So what it means is 12 months of your money kept really safe. If it could be anywhere, be it a liquid fund, we recommend the Quantum Liquid Fund, but it could be any place that you think is safe. Quantum Liquid Fund, because it does not take any credit risk and therefore is much safer. But whatever you think is safer, be it a FD or be it a liquid fund, that is a place where you need to keep that 12 months very, very safe. And rest, whatever is money is left, should be split between equity 80% and gold 20%. And within each of the buckets, you need to diversify. For example, in the equity bucket, you need to diversify across different styles. And given quantum equity fund of funds represent a good mix of styles, a good mix of market cap, you should invest about 70% of that 80 rupees into quantum equity fund of funds, and 15 each in the ESG strategy and long term. If you fill these three buckets, your needs of equity investing are kind of taken care of. And 20% into gold fund or gold saving fund is a better way to take exposure. So with that, I think I'll hand it over, Sandeep, back to you to take on for further slides.
Hi, good evening, everyone. So before going into the products, let's discuss how the market is for the fixed income. So I have listed some major drivers of fixed income in the current environment. So we had a big rate cutting and liquidity infusion cycle. So we had a big rate cutting and liquidity infusion cycle after the COVID, and even before that. But now that thing is unwinding, and it's not just in India, it's globally. So we have seen US Fed talking very hawkish, talking about a large rate hikes in this year and next year, and also talking about balance sheet unwinding. That means they're going to withdraw liquidity. They're going to reduce the dollar liquidity, and that will have impact across the globe, across all asset classes. In the domestic side also, we have seen RBI hiking out of turn on May 4th. So unscheduled monetary policy. And they also reduce the liquidity, the CRR hike. So when they hike the CRR rate, that means banks have to keep some extra money with the RBI, and that money will not be available for market to invest or to lend. So even in domestic market, we are seeing liquidity is now withdrawing. But still, in the absolute terms, liquidity is much higher than what we had earlier and what we are used to. So there is a possibility that they will continue to withdraw liquidity. They'll reduce the surplus liquidity, and they'll continue to hike the repo rate, the policy rate. The third big angle is the demand supply, because after COVID, government also came into spending more, and they widened the fiscal deficit. So means their expenditure is much higher than their revenues, and the gap they are filling with borrowing from the market. Now, when they borrow more, that put pressure on the bond market. Bond market start demanding more interest on the extra borrowing. So we had a government borrowing close to 7.5 lakh crore before the COVID. And this year, if you see budget, what government presented in February, they are going to borrow 15 lakh crore from the market. So it's almost double of what we had before the COVID. Now understand that your demand can't increase at that pace. You have doubled the supply of bond or your borrowing, but demand is limited. So last 2 years, RBI was big buyer in the market. They consumed more than 2 lakh crores, and in 2020, even more than 3 lakh crores of the supply. But this year, when RBI is reducing liquidity and hiking rate, it would be in conflict with their monetary policy direction. So probably their capacity to buy will be limited this year, and that creates an imbalance in the debt market. So broadly, these are three big negatives for the bond market. As far as external position is concerned, we have some comfort from high FX reserve. So RBI has close to $600 billion of foreign exchange reserves, what they built over the years, but mainly in the last 2 years when we had a big FX inflows, foreigner putting money into India through FDI or FPI. So now it's even the status position that RBI bought these reserves so that they can curtail the volatility, or they can sell whenever they see pressure on the FX side. So we have high crude oil prices. Our current account is widening, but given the FX reserve, we have some comfort. We can't say we are immune, but still we have some comfort. So broadly, we have to look at the monetary policy, both at the global and the domestic side, and the demand supply to navigate this interest rate cycle. Now, when I look at the bond market, we try to play on the margins, what is happening, the nuances in the domestic monetary policy. So as Chirag has talked about, that our inflation problem is very different from what US is dealing with, what other monetary authorities or other advanced economies are dealing with. In India, we didn't have that kind of fiscal stimulus like what US has done, or the Euro or Australia was doing. And so during the recovery, this recovery is not even. There's some part of the economy which is still lagging, and that is kind of limit the RBI's ability to hike rate, right? So now going back to when I look at the market reaction, so the best thing is to see how market behaved in earlier rate hiking cycles. So the highlighted area you see, that is the earlier rate hiking cycle. And every time you can see that the orange line, which is the bond yield, that kind of move ahead of the RBI. Whenever RBI about to hike rate, you see very big jump in bond yield. And then when they actually hike rate, it doesn't move that much. There is some up move, but it becomes less sensitive to rate hiking cycle. And similar kind of movement we have seen this time as well. So if you see at the right hand side, the highlighted area, repo rate was flat at 4%, but you can see that yields are moving higher. Just now in this month on 4th of May, we had a 40 basis point rate hike, but bond yields are much higher than what they were at the bottom in this cycle. So this shows how bond yields have moved up across the yield curve. So when you move from left to right, you see higher maturity of bond, and at the extreme left side, you can see the repo rate, which has moved by only 40 basis point since start of 2021. I'm not just talking about this year, but when you look at the bond yields, that has moved up quite a lot. So the 2-year yield, you can see 113 basis point jump in 2021. And now in the last 4.5 months, we have seen 151 basis points of jump in bond yield. And similar kind of jump across the curve, even for the 10-year, if you see 56 basis point last year and now 90 basis point in the last 4.5 months. So already it has moved up by 146 basis points, despite only 40 basis points of rate hike by the RBI. So this is a market tendency. They always try to preempt the policy action and discount it in prices. So much of the rate hike is already discounted to some extent. And as RBI actually hike rate, we may not see this kind of action. Now, how to find opportunities? So we know that RBI is going to hike, but there will be some part of the curve which may not move that much, but there are other part of the curve which may slightly move up. So this is the yield curve, which shows yield at various maturity. This is absolute yield you can see, which are nominated at the current yield levels. And you can see that much of the yield curve is already above their pre-COVID level. So before the COVID, the repo rate was 5.15%. Now the repo rate is only 4.4%. This is decided by the RBI. But much of the bond yield, even the 1-year yield, you can see that is at 6%, much higher than their pre-COVID levels. And almost entire yield curve is above the pre-COVID level. It's not just the pre-COVID. If we compare it with the start of the rate cutting cycle, so this rate cutting cycle is started in February 2019, right? We had a big growth slowdown after IL&FS crisis, and RBI started cutting rate and fueling liquidity. So even before that, much of the yield curve is very close to that level. So now the idea is that when RBI actually hikes rate, probably this part of the curve, the 3-month, 6-month, this part of the curve will move up very fast, but we may not see that kind of reaction at the longer end of the curve. So there will be some reaction, but it may not be that significant. Now that offers some opportunity. Here we find some risk reward balance. See, bonds won't be immune. There are a lot of uncertainty, but we still have some high accrual at this point of the curve, where around 3 to 4 year maturity, which is already at a significant spread over the repo rate. Now, if you are, say, investing in the fixed income space, we can see it from 2 angles. One, if you are investing for liquidity in liquid fund or ultra short term or these kind of categories, if you are parking your short term surplus cash, we should expect higher return as short term rates move up. Your return on liquid fund or these categories, short term categories, will improve. And second part is, at the later part, we have some opportunity in the bond space, bond fund. but still there is very high uncertainty. I'll highlight this part, I'll make it bold so that all of you know that if you are hunting for higher return, make sure you have a higher holding period. Keep your holding period long, at least more than 3 years, so that you can ride through this volatile period. We can see that rates are very close to their 2018 level, much higher, but environment is very different. We have crude above $100. There is a war going on, a big war between two large commodity producer countries. So that can change this market dynamics in any direction. So if you are investing, make sure you have a higher holding period in fixed income space. So this is a chart which shows that for liquid fund investors in our 12-80-20 allocation, the investment in the liquid fund, as RBI start hiking rate, you will see this this line, the return on liquid fund or the portfolio yield of liquid fund moving higher. And you can see in past how it has been very close to repo rate or the 3-month treasury bill rates. So it's better to remain invested if you are conservative investor, and if you are if you have a shorter holding period, or you are parking your emergency corpus. And if you are looking at debt funds, make sure you have a longer holding period and you can ride through the volatility. Thank you. With that, back to Sandeep. Yeah, thank you.
Thanks, Pankaj. Thanks, Pankaj. Now we will have a view from Ghazal. In the 12-20-80, you must have seen we have given an allocation of 20% on gold. We are big believers on gold. So on the gold view, Ghazal, over to you.
Thanks, Sandeep. So within the 20% allocation to gold in the 12-20-80 framework, we recommend that you take allocation to gold through financial instruments like gold ETFs. Gold ETFs invest in 24-karat physical gold. Each unit of a gold ETF is backed by 24-karat physical gold. And gold ETFs do not have any making charges or premiums that are associated with physical gold. Also, you don't have to worry about purity, storage, insurance of gold when it comes to investing through gold ETF. Gold ETFs are traded on the exchange, and that's why are very liquid. You can buy and sell your holdings at any time close to the market price. So in terms of purity, price efficiency, liquidity, even regulation, because gold ETFs are regulated by SEBI, they can be a good choice for investors compared to other avenues of gold investment. And if you do not have a demat account and prefer the SIP route of investing, you can also consider the Quantum Gold Savings Fund, which invests in the underlying, which is Quantum Gold ETF. Moving on to the next slide, I'll start with what is driving gold prices. So real interest rates in the US are a dominant driver of international gold prices. Real interest rates are nothing but nominal interest rates adjusted for inflation. So currently inflation in the US is at 40-year highs of about 8.5%, and nominal interest rates on the government's 10-year bond is close to 3%. This means real interest rates based on current inflation numbers continue to be deep in the red, close to -6%, as you can see in the chart on the left. Now, this is ideally a great environment for gold prices because historically gold tends to do well when real interest rates are negative, because in that scenario, the opportunity cost of holding gold is low and it helps preserve value. But of late, we have seen gold prices cooling down. The reason for that is because of the Fed's aggressive pivot, wherein they are raising rates to cool inflation down. So the market expectations of future inflation in the US is actually lower, with the belief that peak inflation is behind us. As a result, we're seeing real yields on US government bonds, which are based on future inflation expectations. They have turned marginally positive. So if you see the chart on the right, gold has seen some weakness since these real yields have turned positive. However, these low inflation expectations can get repriced upwards going forward if inflation proves to be stickier or if the Fed eases its stance, as recession risks pile up. So as and when that happens, we can see some strength in gold prices again. Coming to the next slide, let's talk about the other macroeconomic factors that are influencing gold prices right now. So gold prices have been moving up and down in the range for some time now. So on the one hand, we have a hawkish monetary policy world over led by the Fed. This has resulted in higher interest rates and a stronger dollar, which are both negative for gold. But on the other hand, we also have a few tailwinds. So firstly, we have the Russia-Ukraine war that doesn't, it's been 3 months now. We don't see an end to it yet. So threat of an escalation of the conflict or, use of nuclear weapons, these kind of threats are still looming on Europe and the rest of the world. So as a result, some geopolitical risk premium has gotten built into gold prices. Secondly, because of slowing growth, tighter monetary conditions and the risk aversion, we're seeing a lot of volatility in the equity and debt markets. This also generally tends to support investment demand for gold. The third tailwind, of course, is inflation, which is at multi-decade highs. The economic sanctions against Russia will continue even after the war ends and will continue to pressure global energy and food supply chains. So, and gold has a proven track record when it comes to periods of high inflation. It helps investors preserve purchasing power. So this too will support, interest in gold. The fourth tailwind, so because of higher inflation and high interest rates, we are seeing, there is going to be some negative impact on consumer demand, consumer sentiment. Even corporate margins, corporate borrowing will be impacted. So risks of recession are definitely on the rise. In addition, the derailment of economic and social life in, say, Russia and Ukraine and China's COVID policy, all of these are slowing down their respective economies, and that slowdown is likely to spill over to the rest of the world. Gold tends to do well in times of economic distress when other risk assets tend to suffer. And lastly, because of the higher global inflation and elevated oil prices and the FII outflows that we're seeing in the Indian equity markets, the rupee has been weakening. A weaker rupee gives domestic gold prices a push. So as you can see, there are headwinds and tailwinds and a lot of conflicting factors. So we're going to see some push and pull in prices, gold prices for the time being. And we believe this can be a good entry point for long-term investors. So on the next slide, we talk about why are we bullish on gold prices in the long term. So as we see it, there could be two scenarios going forward. In the first scenario, slowing growth, financial market instability, and even the risk of potential debt crisis. All of these can actually test the Federal Reserve's resolve to tighten liquidity and hike rates, right? And if that happens, we're talking about low real rates for longer and a weaker dollar. Now, why are we saying this? It's because since the global financial crisis, the Federal Reserve has repeatedly ended up being less hawkish than it promised in order to maintain financial stability. For instance, the quantitative tightening that the Fed embarked on in late 2017 was abandoned by mid-2019 because global growth was slowing on account of the US-China trade wars, and the Fed resorted to rate cuts to support the economy at that time. And today we are barely 3 months into the tightening cycle, and we are already seeing signs that the US economy is slowing down, it's weakening. A lot of economic indicators have missed expectations. So even globally, we are seeing downgrades to growth forecasts. So this tells us that an aggressive tone of the Fed can soften going forward as it has in the past. And if that happens, if we see a sort of U-turn in this hawkish policy of the Fed, that will be a big positive for gold. The second scenario, we think, if the Fed continues with its aggressive tightening in the face of slowing growth, that would not be good news for the global economy, because between mid-March and mid-June this year, the Fed has raised rates from 0 to 1.25%, or will be, by mid of June. So that's one of the largest and fastest rate hikes by the Federal Reserve. So understandably, this will put brakes on the economy, which since the global financial crisis and even more since the pandemic is used to, easy liquidity conditions and low interest rates. What makes the current situation even more complicated is the fact that, amid the supply chain disruptions of the pandemic and the war, the Fed's power is actually limited to slowing demand. So if the supply chain pressures sustain, and aggressive tightening would definitely throw the global economy into a recession and might not really, have much impact on inflation. So economic distress and stagflation, if that kind of scenario comes up again, gold tends to do well. So long-term gold will prove to be a relevant asset class to hold in your investment portfolio. And finally, I'll move on to the next slide, where we've tried to highlight gold's role and utility as a portfolio diversifier. So gold has, an inverse relationship with risk assets and often negatively correlates with a strong global economy. So these are the returns of the various avenues of investing year to date 2022, and as you can see, the equity markets are down by about 7%. Similarly, debt markets, in response to the RBI hiking interest rates and higher inflation, they too have given negative returns. So we're seeing negative returns on both these fronts, and this has raised concerns that monetary tightening could result in a positive correlation to both equities and bonds, and hence bonds might really not be as effective a portfolio diversifier in the environment coming up. So thus gold can really add value. Gold, if you see year to date, it is negatively correlated to equities, and it has given a positive return of 6.5%. Also, silver is very often compared to gold, so that's why we've shown its returns here as well. Silver also has given negative returns year to date. That's mostly because it is used as an industrial asset and tends to be more correlated to economic growth and equities, and hence fails to provide that diversification benefit that gold can in a portfolio. And lastly, you can see that cryptocurrencies or Bitcoin have corrected in a big way on a year-to-date basis. This volatility, of course, is on account of it being such a speculative asset, and we see that it has shown a lot of correlation to other risk assets. So it is often compared to gold, but it has not been able to prove itself as a portfolio diversifier the way gold has. So over to you, Sandeep.
Thanks, Ghazal, for explaining us how important gold is for your asset allocation. Now we will have Sorbh Gupta who will explain in some few slides about equity class. Over to you, Sorbh.
Thank you, Sandeep. And so we heard about global macro and all the glooms and the dooms. So amongst all this gloom and doom, I'll try to talk a little more because equity is the largest block, is the growth block of your asset allocation. I'd like to talk a little more about where and how the corporate profitability is moving and the valuations, because I think these two are one of the biggest drivers of your long-term equity returns. So if you look at last 4 or 5 years, events that have happened in last 4 or 5 years in India and globally are both man-made and natural. What have they done is that they have skewed the pricing power and the kind of corporate authority more towards larger companies, which are represented by listed companies as well. So if you look at this chart on the left-hand side, this is the sales growth of the top 30% corporates in India, where they are growing now at close to 20% YOY, last reported quarter in December, for which the data we have. And the bottom 30% of the corporates are still degrowing. And this has been the story for long. So the events like demonetization, which was more of a man-made event, then a GST, then came the IL&FS crisis, then came COVID and the ensuing lockdowns, and now the war. All these events have slowly moved the kind of pricing power, the market share gains towards larger companies, because these are the companies who have wherewithal, the bandwidth, the balance sheet power to manage these kind of risks which have been happening over the last 4 or 5 years. So slowly the profitability pool is moving towards larger corporates, and those larger corporates are represented broadly by the listed companies. And that is the reason you are seeing that the corporate profitability has not suffered. While there has been so much social distress across because of these events, the corporate profitability has not been impacted much, at least for the listed companies. On the right hand side, we have shown the net fixed asset, which is like the investments which these companies are doing for the future growth. Here again, you can clearly see that because larger companies are making more profits, they are making more investments. So going forward as well, larger companies are expected to do well as they sweat their assets, which they are creating right now, while bottom 30% of the companies are still undergoing kind of contraction. Now, coming to corporate profitability, which dipped in June 2020 because of lockdown, has seen a very, very sharp growth, sharp improvement. You can see the chart, which is the saffron line, which is the EBITDA, which is loosely the operating profit of these companies, which has seen a very, very strong growth. And even the sales, you can see it's a one-side story. So corporate profitability post-COVID, because of the strong demand and lower costs, have moved up very, very rapidly. And also some of the legs of cyclical uptick, which Chirag had highlighted, that is also helping corporate profitability to move up. We expect this to continue. While there would be 1 or 2 quarters of blip because of input cost pressures on certain sectors, but overall, because of the cyclical uptick in the economy, we believe corporate profitability should continue to improve from here on. Now, the earning downgrade cycle, which was continuing from 2016 to 2020, seems to be ending now. We saw from 2014-15 till 2020, whenever group of analysts expected certain earnings for Sensex companies or other companies, most of the companies saw real earnings getting downgraded as we reached those historical points. For example, people expecting earnings of close to 2,400 rupees for FY18. When FY18 actually ended, the Sensex profitability was close to 1,600 rupees. Post-COVID, that continuous down cycle in corporate earnings seems to be ended. From a very, the trough paid in October 2020, we have seen upgrades. And if not upgrades, of late, we are seeing kind of flattish cycles. So companies are kind of having pricing power. So despite the kind of input pricing pressures that we are seeing, we are not seeing a very big knock on the corporate profitability right now, as seen by the earning upgrades and downgrade changes. So corporate earning uptick is starting to happen after 5-6 years of gap. And from here on, what we believe is that this corporate earning upgrade cycle will be the key driver of the stock prices and not liquidity. From a valuation point of view, we saw a big spike post-COVID. There were 2 reasons. One, the stock markets moved very, very quickly post-COVID as the unlocking happened and demand came back. And secondly, because there was 1 quarter of earning missing, that spike is artificially high. And as earnings have started to normalize and of late markets have started to correct, we have seen valuation multiples also becoming more and more favorable. Last 2-3 months, it's become more and more favorable. This is the Sensex P, but if you look at the broader markets, we can clearly say that value managers like us are seeing much more opportunities than what we were seeing last year. So valuation comfort is starting to come to the markets as cost of capital goes up and corporate profitability come back. That was more of a near-term story. Broadly, to anchor your expectations on asset allocation from an equity standpoint, we have to look India from a little more longer perspective. If you look at India's GDP growth in last 35-40 years, it has averaged close to 6.5%. That is the real GDP growth. And that has been the period where we have seen different interest rate cycles. There has been periods where FD rates were close to 12-13%. That was a period where mortgage rate was 18%. It has gone down to 6%. It moved up to 11%, now back to 7%. And it has also seen a lot of political and social events. We have seen prime ministers getting assassinated. We have seen a lot of coalition governments getting formed and dissolved. Within all those things, India has managed to grow at 6.5%. So we always believe that when one is looking at Indian equities, one should look with a prism of close to 6.5% growth on a real GDP terms, and not a 9-10% growth, which can be a blip. So if you anchor your expectations to that kind of GDP growth, your return expectations are quite well managed, and your portfolio returns are also as per your expectations. So as I was telling you, Indian equities, India's real GDP is grown by 6.5%, and for the next so maybe a decade or two, this could be the broad expectations from India's real GDP. If you add our average inflation has been close to 5.5%, and if you add that the nominal GDP that India has, it's close to 11 to 12% over a longer term perspective. Now, typical companies' revenues are in nominal terms because they have pricing power and they take price increases during the time of inflation. So typical companies' revenues will also grow at close to 11 to 12%. And assuming that they have pricing power and their profitability remains the same, their profit growth will be close to 11 to 12%. Now, because as I was telling you, there is a structural trend over larger companies getting larger. So listed entities, listed companies, larger companies can grow a bit faster. So they can grow at 13-14%. And a smart portfolio with the ability to pick good businesses and at good valuations can give you a return of close to 14 to 15%. So this is where your expectations from long-term equity returns should be anchored around. Close to 15% is what a large cap equity portfolio can generate from a longer-term perspective in India. So within the equity block, 15% of your allocation should be towards quantum long-term equity value fund, is what we believe. Now, value fund is a fund which tries to balance between capital appreciation and capital preservation. So QLTVF, a quantum long-term equity value fund, has three broad guardrails. One is liquidity. So the portfolio is very, very liquid. So in terms of high redemptions or illiquid market environment, the portfolio NAV does not get impacted. A very, very strong focus on corporate governance. So companies not passing through corporate governance filter are a total no-no, despite they being a very high weight in the index. And valuations, being value managers, is a key anchor for a stock to come in. Valuations with some catalysts is a combination that we run in this portfolio. As of now, our portfolio allocation reflects an economic revival. Our positioning is geared towards an economic revival in India. So if you look at consumer discretionary, it's close to 17% weight, where while there are a bit of headwinds on the cost side, but valuation comfort is still very there. So we are very, very comfortable with the valuations in the consumer discretionary space, especially on the two-wheeler side. So our positioning is quite heavy over there. Financials, again, the whole cycle is benefiting them. The credit cycle has already peaked about 2 years ago. So the profitability is improving because provisions are getting right back. They are very well capitalized. And the credit growth should pick up as the economy starts to improve. So we have a large weight in financials. Materials, again, will benefit from a corporate kind of upcycle in the Indian economy. So a reasonably good weight in the materials. And utilities close to 10%, because in this inflationary environment, higher inflation or higher costs are a pass-through for them. So it does not get impacted. They do not get impacted to inflation. So that is the reason it's a close to 10% weight in our portfolio right now. Now, within this environment of inflation and interest rates, we need to take care of what will be the impact on the portfolio from a bottom-up perspective. So one thing is, as interest rates go up, companies which run high on debt, their profitability will come under pressure because their interest outgoes will increase. So within our portfolio, when we did a stress test, close to out of 30 companies, 8 companies are financials. 13 companies are net cash companies. They don't have any debt. And companies with very minimal debt, which is less than 0.4 debt to equities, are 7. Only 2 companies that we own have higher net debt to equity of 1.5 times. And both of them are electric utilities where increased costs are a pass-through. So our portfolio is quite well protected from this higher interest rate and higher inflation environment from a stress test perspective and earnings defense perspective. Even from a valuation standpoint, if you look at our funds valuations, quantum long-term equity value trades at close to 18 times trailing 12 months. If you look at Sensex, it is trading as close to 26 times. So close to substantial discount to BSE 30 index. Even on a forward earning basis, we are at a deep discount. We are trading at close to 16 times vis-a-vis index at close to 22 times. So we have a lot of valuation comfort, and in the next slide, I'll try to explain how valuation comfort help in this rising interest rate environment. Now, what happens in an higher interest rate environment, PE is also as sensitive as a bond to higher interest rates. So as high duration bonds are sensitive to higher interest rates and lower interest rates, even PE are also sensitive, because PE means you are generally how many years of future cash flows are you discounting. So higher the PE for a company means you are trying to factor longer into the future, and the sensitivity to the change in interest rates for that stock goes up. So in an environment where cost of capital is going up, portfolios of stocks which have high PE tend to suffer a lot more than low PE. And this is where our portfolio positioning is helping us. If you look at our portfolio, as I explained, we are trading at very attractive valuations vis-a-vis benchmark and some other peers. So that is one of the defensive, being value managers, that we generally tend to buy at a deep discount to the intrinsic value. Hence our valuation is comfortable, and the rate sensitivity is a lot lesser from the portfolio perspective. Now, a lot of questions being asked on whether value style is back or not. So between 2016 to 2019, value had a very tough time because the conditions which are right now, those conditions are totally opposite of that. We had very little corporate earning growth, but a lot of liquidity. Few companies did well, and the valuations of those companies continued to move up. And we, being value managers, it was very difficult to justify and buy those companies. Now it seems that the environment is turning in favor of us, in favor of value managers. It's very similar to what happened between 2000 and 2007 and 8, where growth was better, liquidity was less. We're entering the very similar environment, and appears to like that the cost of capital is getting normalized and it is increasing. And as it increases, high PE would suffer a lot more than low PE. Plus, broad-based growth means the basket of companies which are doing well and have growth catalysts are much more than very few companies, which was happening between 2016 to 2019. So we are in a very favorable environment. Hope this continues, and value, if this continues and cost of capital continues to normalize, we'll see value doing much better than growth. Maybe I'll end up here, and I'll give the rights back to Chirag, who will take you through Quantum India ESG Equity Fund, which is part of the equity block.
Thanks, Saurabh, for your views on equity. I would like to invite Chirag. Chirag will give a brief on ESG and Quantum Equity Fund of Funds. Post that, we will take all the questions. Over to you.
Sure. Thanks, Sandeep. So in the ESG equity fund, it's like investing with where your values lie, right? It's trying to achieve that triple bottom line of good for the planet, people, and profits. At the end of the day, we believe that sustainability over the long run results into that long-term profitability, and therefore an allocation of 15% of your portfolio to ESG equity fund. ESG, we believe, is over a period of time going to become more mainstream, and will be a lot of strategies that will incorporate ESG in a big way going forward. So what are we offering? What do we do in this ESG fund? It is a combination of three things. One is looking at ESG, companies that are well governed, who kind of take care of the stakeholders, ensure that the environment and society is taken care of, or they do not have an adverse effect on the environment and society. And the other way around also, ESG works on double materiality, the impact that companies have on the environment and society, and what kind of impact, because of, say, example, climate change is going to have on the companies. Are the companies getting up for that scenario or not? So ESG takes care in terms of looking at or measuring sustainability of companies. At the same time, if you combine that with financial stability of companies, as Sorbh said, high leverage could be a deterrent in terms of performance for that companies. Similarly, whether companies are not high levered, have good cash flows, the capital allocation decisions of the companies have been good, they have good management, good board that kind of takes care and ensures that the company is on the right path. At the same time, we ensure that there is good diversification of the portfolio. We'll come to where the fund is diversified, how it is diversified. Plus, we ensure that it's a very liquid portfolio. And we nudge companies to what they are today. They are already good companies when it comes to their sustainability, but we nudge companies, talk to them and engage with them to try and make them better. So I think this combination of good sustainability, financial stability, and diversification is a great combination for achieving that long-term returns. You're banking on sustainability as a driver of long-term performance. ESG, I know it's very new for many. As it stands, E stands for environment, S stands for social, and G stands for governance. There is a method in terms of how you measure ESG. Currently, it is highly subjective, given the data that the companies give out is kind of very, very less. Companies are improving, regulators are forcing them to come out with more data. So we'll see a lot more standardization in the way people assess ESG. But so far, it is like beauty. It lies in the eyes of the beholder. How you perceive the practices of the company from an ESG perspective is what drives your belief whether those companies are sustainable or not. So we look at lot of data sets, direct what the company disclosures are, and we try to verify those claims that the companies are making, try to get more data so that we can assess and evaluate the companies better. And we kind of score those companies, and we arrive at a final ESG score, looking at and assessing each of the disclosures, each of the data sets that we collect from companies. And the score of companies in our framework, everyone will have a different framework, and there are many different frameworks out there. But in our framework, which has gone through a lot of understanding, learning, reassessing exercises, and our framework tells us any company will have a score of +30 to -70, and any company which has a positive ESG score becomes eligible to be the part of our portfolio in the ESG fund. We also look at financial sustainability, as explained before. Any company which has a very high leverage will not come into our portfolio. Any company where the return on invested capital, the minimum threshold that we look at is 12%, and the growth in free cash flows has to be 7%. So from a financial company may have a very good green credentials, but if at the end of the day, it does not make money for investors, or it may not be able to pursue its ESG agenda of getting better on all its ESG traits, then probably it may not be a good company to invest. So we've, apart from being sustainable, being good, we assess whether they have enough financial strength to pursue their ambition to grow and make money from investors while doing good. And if you look at the current portfolio, it is a significantly heavyweight in information technology. Tech stocks, it has a higher weight. Given the tech sell-off that we have seen in the US, even Indian companies have gone through the brunt of some sell-off, and therefore you will see the impact on performance to some extent currently. Consumer discretionary is a significant high weight. Sorbh explained that, we see a lot of levers because as the economy grows, as income increases, consumer discretionary spend will increase, and therefore benefit because of the growth that we'll see. Materials, again, given the cyclical uptick, there will be need for more materials, and therefore demand for materials may remain strong, and therefore we have a higher weight in that sector. And we also have higher weight in consumer staples, which we have increased post the correction. We did have a higher weight. We have further increased that post correction, given that there are a couple of new names which are looking attractive, and we have increased allocation to that. We are underweight financials. We are underweight. We are almost equal weight industrials. We are underweight healthcare and utilities in our portfolio in the ESG fund. So in a way, given the economic revival that we are seeing, it is also positioned to benefit from that economic upswing that we may see in the economy. Portfolio characteristics, like value fund is real value. It's available at a discount. This depicts more like a growth characteristics. So on a trailing 12-month basis, if you see the PE stands at close to 35 times versus 28 times for the BSE 30 index. So it's expensive on a trailing 12-month basis. But if you were to look at next 2 years, because we invest for the growth of those companies. So if you look at the earnings growth over next 2 years for the ESG portfolio is upwards of 24% versus around 17.5% for the BSE 30. So significantly high growth for these companies. And if you were to adjust the current PE to the earnings growth that the portfolio offers on a PEG ratio basis, which is PE adjusted for growth, it is at 0.8 times cheaper than the BSE 30. So it may look expensive on a trailing basis, but on a forward basis, the portfolio is cheaper than what it should be. So that's about the ESG fund, but the bulk of your allocation, we think, should go to the Quantum Equity Fund of Funds, which is a basket of well-researched equity schemes. It has 9 equity schemes across market caps, 7 from the large cap space, and 6 from the large cap space, and 3 from the non-large cap space. From your perspective, it is a logical extension of why you come to a mutual fund. Given you don't have time, knowledge, inclination to invest in stocks directly, therefore you come to a mutual fund. Similarly, there are 500 plus equity schemes out there. You need to select 5 to 10 funds for your portfolio. So how can you do it if you don't have that enough time to devote to selecting those funds, or you don't have that knowledge or inclination? So here you get a ready-made solution, which is a research-based fund selection, something which selects consistent performers, not the top performers, because what is top today may not remain top and may give you that disappointment. And it kind of tries to strike a balance between risk and return. Plus, it is diversified across caps and across different styles. And for you, it's just one investment you make, and that you're taken care of. So as I said, it's split across market caps. Large cap is about 70%. Mid and small cap is more than 20% of the portfolio. Whereas BSE 200 index is about 91% in large cap and only 8% in mid caps. And if you look at the top 10, it is also very well diversified across sectors, across names, and it is not very, very concentrated. It's also diversified. Top 10 stocks just count for 36% of the portfolio. And if you look at from a sector allocation perspective, again, consumer discretionary, we expect to do well. It is higher allocated than the index. Financials are almost similar to what the index weight is. It is higher allocated to industrials and higher allocated to materials, which we think will benefit because of the upswing in the economy. Also here on a trailing basis, if you see, it's 32 times versus 28 times for the BSE 200. But if you look at the earnings growth for the portfolio, it is close to 24% growth on a 2-year basis versus only 18% for the index. So on a PEG ratio, which is PE adjusted for growth over next 2 years, is 0.78 for the equity fund of funds versus 0.97 for the index. So it's cheaper if you consider the growth that we will see for next 2 years. Given that we've already spoken about this, that you should diversify despite we think equity is likely to do well and benefit from the upswing in the economy. There are also risks. So you diversify in the 12-80-20 allocation. And I know that many investors say, yes, we understand this, why you're saying 12-20-80, but we need more evidence. And here is the evidence that we're talking about. If you look at long term, this is since 2012 data, January 2012. And if you look at the since inception row, the strategy 2080, because 12 is something that you keep very, very sacred. You don't consider even their returns because that you cannot touch in a way. And you need to keep it very, very safe. So if you were to consider the 2080, the rest part of it, the returns on that since January 2012 were close to 14.9% versus Nifty giving a return of 13.75%. So it's outperformed Nifty, and this is post expenses, provided you follow 2080, and there would be right times when you rebalance the portfolio. And if you had followed that strategy, your returns were much better than even equity index returns. And if you look at the risk element, when equity markets fell, like for example, during the COVID downturn, it fell significantly. And there have been many corrections that you can expect in equity markets. The fall in equity market that we saw on a month-on-month basis was 29%, whereas this strategy, because of diversification from gold, it would have fallen only 20%. Also, the average standard deviation, which is the ups and downs volatility in portfolios, this portfolio, 2080 portfolio, would have a volatility of 13.8 versus Nifty volatility of 16.7%. So it is better on returns, it is lesser on risk, and it is very, very simple for you to follow. Just do the 12-80-20 allocation, and that will take care of earning you that good long-term performance that will help you meet your financial goals. So with that, I hope you will try this 2080. There is a dashboard on our website. You can try doing that. It is very, very simple. In a few clicks, you can understand where your money is going. Are you okay with that allocation? And in a few clicks, you are invested in all these schemes. And the 2080 is a very, very convenient thing that you can have, which will help you achieve your long-term goals. So with that, Sandeep, over back to you.
Thanks, Chirag, for the presentation. Thanks, Ghazal, thanks, Saurabh, and thanks, Pankaj. We would like to take the questions now. We already had some questions from some of our investors who already emailed us. Yeah. So, Chirag, this is to you. Normally, analysts are always good in rightly portraying how good future is, but normally people do not hear when to exit it. So, if you do not exit or if you do not redeem your money, so the profits are more of a virtual. Normally, advisors do say that whenever you reach your goal, you should take your money back. Sure. So what are your views on this?
So, I mean, given that if investors who have heard us for long, we have always also portrayed the risk, and when it is very, very risky, we have also said that you need to stagger investments, or, this doesn't look comforting from a valuation standpoint or the way economic scenarios are panning out. So that is one. And second is, if you follow this 2080 strategy, and if you were allocated to equities and that have gone up and become frothy, you need to rebalance the portfolio. And when you do that rebalancing, keep your investment simple to 80-20. And, if you rebalance the portfolio at the right times, given that when you see equity markets frothy or when it reaches certain thresholds, you kind of rebalance your portfolio, it becomes very, very easy for you to kind of have that smoother ride and still make a decent amount of wealth over the long run. Like this example shows here, if you were to follow the 2080, despite the falls that we have seen in markets, despite what happens on a macro, despite the economic scenario changes, from a investor standpoint, it is kind of sometimes difficult. You can let the fund managers navigate their funds. You will be adequately allocated, diversified, and that will take care of the ups and downs that you see in markets. So I think that will be better rather than trying to time the market, because sometimes you've seen investors miss the bus and it becomes a futile exercise in trying to time those markets. So what I will suggest is leave it on to the fund managers to navigate their respective strategies, and you be allocated, diversified across asset classes, within asset classes, and that will take care of when you do. Plus, we will not be shy in giving our views if we see that things are not going right or earnings growth is not coming. So, for example, right from 2014-15, when the street was gung-ho on equity markets and we didn't see activity pick up on grounds, earnings growth was not coming through, we were very upfront telling that view to investors. So we will not shy, and we will tell how we see markets, how we see economies, and investors can take their call. But rather, I will say that stay diversified. That will do the working for you.
Thanks, Chirag. So this is a question on Quantum long-term equity fund. This is from our existing investor who has been an investor for around 12 years, and the fund performance is quite disappointed with him. So, and there he has been running an SIP for last 10 years. So can you share what is the team right now looking at, and also give us a brief on the performance of Quantum long-term equity fund for last 10 years and what we did?
Yeah, Sandeep, so that has been a question for us. As I highlighted during my brief presentations, that things have been rather tough for value investors between 2017 and 2020. Yeah, so what was happening was some frothy valuations in some stocks and very concentrated rally happened. And we, being value managers, could not buy those names at those frothy valuations, and those stocks continued to do well because of high liquidity. Now, because prior to 2016, if you see period between 2010 and 2016, and essentially 2006 and 2016, the performance was very, very good. Because the value style was not out of favor, it was very much in sync, and we got opportunities at the price that where we wanted to buy certain stocks at a fairly good margin of safety. Post 2020, March 2020, that was the first time in 2-3 years that we got opportunities to pick up some good sector leaders and great names into the portfolio, which we have done. And since then, our performance has started to improve. But because what is happening in last 1.5-2 years is that the value style is still working in patches. I'll give you an example of what happened in 2021. 2021, from Jan to July, August, our fund was outperforming the Sensex by 800 basis points and BSE 200 by close to 500 basis points. Because the value style had started to show traction. But in the next 4 months, again, the growth again picked up. Some of those stocks again started to do well, which were expensive. And again, we lost that initiative, and we ended up very much in line with the benchmark. Again, this year we have started on a very strong note. Because again, what is happening is that high PE companies are seeing a larger dip in this correction, whereas wherever there is a valuation comfort, those stocks are doing much better. And typical traits of value style coming back in vogue. What we believe is, if this current environment continues, this type of things will get stronger and stronger. This type of characteristics will get stronger and stronger. And you'll see that the fund performance will catch back to longer term averages. We are betting on the increase in cost of capital and broad-based growth, which gives us a lot more diverse opportunities and not very few stocks to invest into. Portfolio allocation, as I've told, is towards cyclicals. And with the cyclical recovery in the economy, we see earning upgrades coming through in these companies much better than others. And the fund performance will track those earnings coming through. So we are quite excited about what is happening right now in terms of cost of capital, in terms of broad-based economy and cyclicals. So we believe that we should catch up the underperformance that has happened between 2017 to 2020. And that will ensure that long-term numbers also start to look good, because what happens is that those 3 periods are suppressing our longer-term numbers also, return numbers also. And once we catch up to that and recover that, the longer term numbers will also start to look better.
Thanks, Saurabh. Yeah, thanks, Saurabh. Also, on your future allocation, you can always look at it 12, 20, 80. Since you are an existing investor, we can always log into our invest on next section and do your future allocation as per the allocation that you're seeing on the scheme. So Pankaj, there are two questions for you on the net. Is it the right time to look at sovereign bonds, or is it advisable to shift to debt investments if invested for a long term in a bank or a PSU debt funds? Seeing the present scenario.
Right. So as I mentioned in the presentation, that valuations have definitely improved. So even at if you look at the 3-year bond, which is trading very close to 7%. That means if you buy a bond and hold it for 3 years, your return will be very close to 7%. That looks good compared to the fixed income options we have at this moment. The only problem is if you're investing for maybe shorter period, there you can get into trouble. And means we don't know how market will behave in the next 6 to 8 months. If Fed is hiking, if RBI is hiking, we don't know at what point they will stop and how crude will behave given the geopolitics. So there are a lot of uncertainties. We have to keep those things in mind while investing, and accordingly structure your maturity profile and your holding period. So if you have a holding period of say 3 years, try to keep your funds maturity profile closer to your holding period. That would be the better option, that let the fund roll it down by the time you withdraw your money. Or if you are conservative investor, you don't have that much of holding period, or you can't tolerate ups and downs in your NAV on a daily basis, better to stick with the liquid fund or the ultra short-term fund or those categories where we, even in this environment, these categories tend to gain with rise in interest rate. So I think investors can segregate between these two kind of money, the liquidity and the money where they can take some risk, and accordingly choose between these two.
Thanks, Pankaj. Yeah. So we did have some questions of investors had emailed us previous to this webinar. For benefit of all, I would like to combine these questions, and there are some questions in the chat. This is regarding gold. Ghazal, you can take this question. Yeah. The one is basically, why is gold an important part of asset allocation? We also tell people, or we advise people to have 20% of allocation right now. And the second part is, do you see in the scenario gold prices going up? And should I change my portfolio according to that, or what should I as an investor do?
Right. Thanks, Sandeep. So currently, equity and bond markets both are in pain on account of the various factors that we've spoken about, inflation and tighter monetary policies. While tighter monetary policy impacts gold as well, there are other tailwinds like we discussed, everything from geopolitical risk to recession risk to higher inflation, even weaker rupee. So all of this are going to keep gold prices supported. And hence, in this environment, we believe gold can play a risk-reducing, return-enhancing role in investors' portfolios. But having said that, we think it's very important that how you take, exposure to gold is also important. So usually, because we Indians have a preference for physical gold, we tend to choose physical gold to, park our money. But it's also important that you optimize the way you are investing your money in gold. And hence, we urge you to choose more efficient avenues like financial avenues like gold ETFs and gold mutual funds, to take exposure to gold. And on the second question about where we see prices going from here, yes, currently we will see prices, range bound for the time being, mostly because the Federal Reserve and central bankers globally are going to do some front-loaded tightening, and that is going to have an impact on prices. We might also see inflation ease a little bit, but in the medium to long term, we expect monetary policies to become softer again, to become accommodative, to support growth, and that should keep real interest rates in dollar weak and be bullish for gold prices.
Yeah, thanks. One more question, just for it. You touched on geopolitical tensions. They do not seem to end at somewhere. That seems coming. So will this add pressure to gold, and how it will affect it?
Actually, so I would answer this. I think there are short-term implications of the geopolitical tensions for gold, as well as some long-term implications. So in the short term, of course, we're seeing that there's this new superpower struggle between the US, Russia, China, and there are talks about how we can see China following Russia and repeating this Ukraine and Taiwan. So there is a lot of geopolitical risk premium that is getting built into gold prices, and of course the Russia-Ukraine war continues to have an impact. Also, what we're seeing is the Western powers have actually put a lot of sanctions on Russia, but you cannot put those sanctions without hurting yourself. So Russia has a critical role that it plays in global commodity markets, and the sanctions on the country are resulting in an energy food crisis that we're seeing globally. So there's a lot of volatility and uncertainty that in the short term, because of the war, that will keep gold relevant. Coming to the long term, I think this economic and political isolation of Russia that we've seen is potentially going to add momentum to the deglobalization wave, which began with the pandemic, and this is going to disrupt the way financial markets, trade markets have been functioning for a while. So if this deglobalization happens, we might see some more stimulated inflation, because production could move away to more of from globalization to localization. So obviously a higher inflation rate environment, like I said, is supportive of gold prices. And lastly, I would also say the Russia-Ukraine war has actually accelerated, the erosion of US dollar's dominance, because like right now, the US has put sanctions. So a lot of countries feel that, the US is actually weaponizing its currency. And we're seeing a lot of countries actually, diversify their reserves away from the dollar. So of course, the dollar continues to be the reserve currency of the world and will be for the foreseeable future. But definitely this weaponization of dollar that, that countries are seeing, we might see the global monetary system move a little bit away from the dollar, and gold could possibly play a more prominent role than before.
Thanks, Ghazal. We at Quantum are a big believer at gold, in fact, and we also tell people that gold is also an insurance to your portfolio. So there is also been a question from a distributor of us: will an IFA get commission on gold ETF? So presently there are no commissions on gold ETF, but you can surely look at gold savings fund of Quantum, invest in our gold ETF itself. So moving on, we have a question on equity. This is for Saurabh. Is it not advisable to shift funds in high demand yielding stocks like Vedanta, which yield about 14%, or PSUs like REC, PFC, etc., where the dividend yields are high? And normally people do resonate with stocks that are high dividend yields.
Yeah, thank you, Sandeep. But if you allow me, there was one follow-up question on my answer of the underperformance, about the underperformance vis-a-vis peers. Now, I'd like to address a few things over here. One is that the category of value itself was created in 2018, if I'm not correct, when SEBI categorized these funds. And a lot of our peer group funds have come into that category because SEBI capped only one fund per category. So a lot of those funds came into this category as redefined as value. So SEBI does not define what value is. Right? It has defined, it has described a category, but it does not define what value is. Now, according to us, for a value fund, the portfolio characteristics should be consistently having valuations or PE multiples lower than the benchmark, higher dividend yields, and lower price to book value, and definitely a layer of corporate governance. So if you look at our peer groups, some of them are clearly much high in terms of PE multiples. So we are not in a position to why they do that and how do they define value. But according to our definition of value, clearly having such a high PE multiple of their portfolios does not clearly qualify as value. So I think you should also look at portfolio characteristics of what portfolio characteristics each of the portfolio is reflecting. And then within that prism, then you have to look who is really value and who is not really value. If you look at global examples, every pure value investor has underperformed between the period of 2017 and 2019-20. And still that comeback is still not very clear, but it's coming back. The value is definitely coming back, but it's still patchy. And that's a global trend. So in this environment, if value has done well for some of the funds, I would request the investors to do a deep dive on whether they are truly value or not. Not questioning their investment strategy. They might have a different definition of value, but would strongly recommend to look at the portfolio characteristics.
Thanks, Saurabh.
Yeah, on the second part of the question, Sandeep, on high dividend yielding stocks. Now, dividend yields are definitely good things, but there are other things as well. Sustainability of earnings is one very important aspect. Balance, business quality, valuations, and corporate governance. Some of the names that you've highlighted get filtered out on terms of corporate governance for us, and some of the names in terms of business quality. So dividend yield is just one of the factors. We'll also look at multiple factors within our research, which includes business quality, which includes corporate governance, and the sustainability of cash flow. So some of the PSU names that you've highlighted, we have enough examples on the PSU space which continue to look very attractive on the dividend yields, but the capital returns from the stock were negative for multiple years, and eventually the dividend yield also collapsed because the cash flow got wiped out for those companies. I'd not like to name them. So there are multiple factors, dividend yield being one of them. So that would be my reply on the question that you raised.
Thanks, Saurabh. Yeah. There's another question. Should we, in the asset allocation, we are recommending gold, so should the silver replace it? Yeah. Chirag would like to take it?
Yeah, sure. Silver, if you look at silver as a metal, it was like gold at one point in time, part of used as money. But having de-linked as a form of money, 70% of the usage today for silver comes from industrial metals. And when you have such a high usage of as industrial metal, it has a very high linkage to economy. And when your economy is doing well, your equities are likely to do well, and so is the demand for silver. So in a way, demand for silver is highly correlated with demand for when times are good, and which is also reflected in your equity market. So strategically, it has the same exposure to what your equities will give you. And therefore, to treat silver as a diversifier will not be a good outcome, because it has a similar exposure. Whereas gold, if you see, has still part of central bank reserves. Everyone flocks to gold when things are not good. There is demand for gold increasing in times of stress. So we have seen that, and over a long period of time, it is a great store of value. So these characteristics of gold make it a very good diversifier as compared to silver, which has a similar view or approach in a way, or exposure to what your equities will give you. So silver will not be able to act as a great diversifier given the economic linkages it has. Silver to some extent is known as half copper, half gold, because as demand within the economy increases, demand for metals like copper, etc., aluminum will increase, and therefore demand for silver also goes through a significant increase. if you look at these days, demand for silver, people expect that, solar panels or move towards EVs, etc., increasing, and therefore demand for silver will increase. Incrementally, we have seen that commodities are or these EVs or any solar panels, etc., are getting more efficient day by day. They are trying to reduce cost, and that is leading to a lot of substitution of higher commodities that are used in making these instruments, be it EVs or be it solar panels. And therefore, to bank on that growth may not give you, again, a good outcome. So silver, you have to be very sure about the demand supply dynamics, the substitution possibilities, and within the things that you think will drive silver, and you need to take a strategic call. It is not a great diversification tool like this chart that Ghazal showed, which said that when equity markets fell in 2022, things like silver, Bitcoin, etc., also have fallen, whereas gold is on the other side of the axis. It has positive returns. Gold has about 6% positive returns, where equities have fallen by 7% this year. Even things like Bitcoin are down 70%, 30%, and even things like silver is down about 2%. So this really tells you, and you can go in history to see when equity markets are in stress, what has done better. And the answer is clear, that gold does better, and therefore it is a great diversifier, and don't try to replace it with things like silver.
Thanks, Chirag. Chirag, you also touched, but if still some investor wants to invest into silver, or you said on other points. So in our asset allocation at the pivot, we have the green play money. So just can you brief our investors what's the green for?
Yeah, the green is for usually people invest in things where they don't understand or don't have sufficient knowledge. Purely it is things that is more speculative in nature. Usually what happens is those things should be very small element of your investments. Something that you invest based on your gut feel or insufficient knowledge is what usually becomes a very big chunk of investors' portfolio, and therefore they don't end up having enough wealth creation or enough returns from their portfolio. Whereas those things should be very, very limited, less than 5% of your portfolio. If you can, really keep it out of ambit and don't have any exposure, that will be ideal. But even if you want to have such kind of exposure, then it should be very, very small percentage of your allocation. It should be less than 5%. So if you are wanting to have an allocation to silver, given it's you think that because of your understanding that supply demand or demand for silver is going to increase and you should have some exposure, it should be within that 5%, and it should never replace the 20% that you have for their gold allocation, because it isn't that great diversifier that gold is, and gold is more time tested and silver has usually historically disappointed. So to treat it as a diversifier and having a higher allocation will not be a good outcome thing. So you should have that play money, which should be very small allocation. And if you want things like silver or any other thing that you think will do well, but have not researched it enough, then that should be part of your play money and less than 5% of your portfolio.
I would like to continue with the asset allocation part only in view of upcoming our index funds from Quantum EMC. We have filed for a Nifty FOF. So how does that product suit with our 1220 or combination? Will the AT be replaced by that? Can you just brief on that?
So the 1220 AT, I think, is sacrosanct. It usually, we have seen it work really well, irrespective of, it's an asset allocation strategy. So we think that asset allocation strategy has worked over time periods, be it any kind of markets, over a cycle, it delivers better returns. So that is not changing. Only thing is within that AT, we have suggested that 70% should be to a broad equity exposure to different styles, exposure to different market caps, and 15 to different styles. One is the value style and one is ESG style. So if you want to have exposure, so these are active ways to get exposure to equities. But if someone says that they should also have passive exposure, then they could replace, but it should be within that 80% of your allocation. So even if you want to have some exposure to Nifty, we believe that over long term, still active has room to outperform given the efficiencies that we see in Indian markets. But despite that, if you want to have some passive exposure, then it should still be within that 80. So either you can have an active exposure or a passive exposure or a mix of two to build your equity allocation, but that 80 isn't changing. So whatever mix you want to have within that, it should all form part of that 80% allocation.
Thanks, Chirag. Also, I would like to inform investors, soon you will be able to, if you are a passive investor, you will be able to build your long-term allocation in 12, 20, 80 by passive allocation. You can have a gold savings fund and you can have a Nifty FOF product. Soon we will have that product on our Invest Online section also. Chirag, one more question on the equity FOF. Now, previously, we on average we used to have around 7 funds in equity FOF. Now, if you see, we have around 9 equity funds in it. So previously, there was an exposure around 13.5% per fund. Now it is around 9 funds. So does this make too much of diversification in equity FOF? That is one. Secondly, there is a question from the same investor, Mr. Umesh Datu, Dr. Umesh Datu. That can this FOF be replaced completely by ESG?
Sure. I think that's a great question. If you look at equity fund of funds, the way we were working, we had 7 funds in the allocation, and we have always said we'll have 5 to 10 funds. And that was also an outcome of research that we think that any equity strategy should have minimum 5 funds. And above 10 funds, you kind of start losing the benefits of diversification. So it will always stay between that 5 to 10 fund allocation. When we were operating on a 7 fund and having that 14% allocation to each of the funds in our portfolio, we saw that most of the funds have a style, and every style goes through a cycle. And the bearing of that fund going through a bad cycle and the underperformance of that led to a significant higher impact on the overall performance of the fund. And what we saw that the consistency in the Indian mutual fund landscape was we saw a cycle of 3 to 4 years, and post which there was a cycle that was not in favor of some funds. So we purposely tried and researched whether we kind of moved from a 7 fund to a 9 fund and increase our diversification, reduce the impact of funds which are going through a bad cycle. How does that work? And that really gave us better outcome, and that diversification really helped to minimize the impact of the fund that has the bad cycle on its way. So from given that research or back testing gave us a better outcome and led us to increase and change our process from 7 fund to 9 fund, we kind of did in the interest of investors, so that the impact of that underperforming fund was minimal on the overall performance. But we keep revisiting our process. We keep trying to see how we can improve that. And if our research tells us that there is a need, if the funds become more consistent and kind of weather the cycles well, then probably if we think that our research tells us that we need to move back to 7 funds, we may move back to 7 funds. So we will keep testing our process. We'll keep improving. And currently, in the current scenario, in the current mutual fund landscape, the way we look at funds, way we analyze funds, and way we see trends in fund performance, and the 9 fund diversification suits better than the 7 fund diversification. And anytime if we think that it needs to change, we will change it in the interest of overall performance for the benefit of investors. Secondly, the question on ESG. If you look at ESG, it's been about very close to now 3 years time frame that ESG is completed, and ESG is still new. It will go through a cycle, and at the end of the day, it is a way of investing. It is a style. It is valuation agnostic. So it will always have its cycles in terms of whenever there is a correction in markets, or wherever there is a cyclicality within the portfolio, which we are trying to minimize through diversification across different sectors. But given that it's at the end of the day a way of investing and it's still nascent, we believe that restricting it to 15% allocation will be a better outcome, and it will not enhance the risk within the allocation of equities. So far we will want to stick to 15%. But if there is more evidence, if there is more compelling reasons to change that or increase that allocation, we'll come back to investors and tell you why we think that. But for now, given that there is a need for diversification across styles, we will limit that exposure to 15% within that overall equity allocation.
One more question, Chirag, on the asset allocation. Now, this is a question which we get across whenever we travel across India. We Indians do have a high affinity towards real estate. Now, why real estate is not a part of asset allocation anywhere? Right.
So real estate, if you look at the house that you own or you live in, is not considered as an investment because you will eventually still need a house whenever and whenever you move into another house, you are still upgrading that. So you'll add on more money and buy a better house. So from a housing perspective, I think if you have more than one house, then probably that's an investment. But if you are just having an allocation in the house that you live, that's not an investment. So that investors need to keep in mind whenever they are looking at their overall wealth. And when it comes to other avenues of investing, real estate being very, very illiquid, it is a big ticket item if you also allocate to it. So generally, people do not have exposure to that, and therefore within the possibilities of building wealth over a period of time, this 12, 20, 80 does better rather than including real estate in that basket, because not everyone will tend to have exposure to that, real estate. And we wanted to keep it simple. People can build it over a period of time, not take that liquidity risk, that big ticket purchase, which may, impact your overall financial planning. And therefore, it's not part of the 12, 20, 80. And we will recommend that, within the overall allocation, I think 12, 20, 80 is enough. So you need not venture out into, different things that you don't understand, be it real estate or be it any other investment. And today, market-linked avenues for investing in real estate are very, very little. They are untried, untested to an extent. And therefore, we believe, to keep it simple, the 12, 20, 80 works better rather than including those avenues within the overall allocation.
Thanks, Chirag. Pankaj, this is a question for you. We already seen the actions by the RBI. So what are your views on RBI setting out the liquidity?
Yeah. So see, inflation is above RBI's threshold, and it's been above RBI's threshold for some time now. We had a higher inflation in 2020, 2021, and now 2022. Things have worsened. So definitely they're going to hike rate, and they're going to tighten the liquidity. On both fronts, they're going to act. But the other side of the story, the growth story, so that is not broad-based. We have seen a rebound in the economy. We see large GDP numbers, but that is skewed, one. And secondly, much of that large GDP growth numbers are actually coming from base effect. And still there are slacks in the economy, and that will kind of limit RBI how much they can hike rate. So our expectation is that probably repo rate will remain below what we had before the pandemic, the pre-pandemic normal, where repo rate was somewhere closer to 6.5%. And liquidity, as per the RBI's own working, they say that if it's 1.5% of NDTL, that's not inflationary, and anything above that can create inflation. So if I convert that into numbers, probably they'll stop withdrawing liquidity as it reaches to surplus of close to 2 lakh crores in the banking system. So current liquidity is somewhere closer to 6 lakh crore. So we should expect some more withdrawal of liquidity. Now, in terms of its impact on investor, means for the liquid fund investor who are putting money in quantum liquid fund, as RBI withdraw liquidity and hike short-term rate, that push T-bill rates or the good quality CP/CD rates higher. And this is the segment where quantum liquid fund invests. So we should expect their returns to improve going ahead.
Thanks.
Yeah.
Thanks, Pankaj. So Pankaj, how are you affecting this in your portfolios going ahead in your both your funds, bond fund and the liquid?
See, the idea is simple. In liquid fund, when we build the portfolio, we think about investors' objective. So these investors, they are putting their emergency corpus or very short-term surplus cash into liquid fund. This is not a money to take risk, right? So our idea is to keep that money safe. That's the first priority. Keep it highly liquid so that whenever they need money, they can withdraw, and we don't feel any pressure whether market is there or there. We can meet redemption anytime, and then we try to generate some sensible return on that money. So entire portfolio is into highly liquid either government securities, or we can call it quasi-government securities, where invest in PSUs, good quality PSU names. So we continue with that asset allocation. There's nothing much to do on the management of interest rate risk in case of liquid fund. Most of the portfolio matures within 30 to 40 days, and you can easily capitalize on rising rate as securities mature, and you can deploy at a higher rate. Now, in terms of dynamic bond fund, so as I mentioned, that current environment is highly uncertain. Much of the rate hike from the RBI is already priced. We can see those in spreads. The 10-year bond is currently trading around 300 basis points above the repo rate. So it's close to 7.4%, where the repo rate is at 4.4%. If I look at history, a long 20-year average of this spread, that is below 100 basis points. So currently, spreads what market has built is significant. So valuations does look attractive, but risks are abundant in this environment. We see all kind of speculation about crude oil, the global food shortages, and how it can affect Indian inflation, because India has more than 45% weight of food in our inflation basket. And the global central banks, especially the Fed, we have seen 2018 they withdrew from their tightening spray. They stopped their QE program. They stopped hiking rates. But remember, that time inflation was not a problem, and this time we have a very big problem in terms of inflation, and we don't know how they will react when actually 2018 kind of situation emerges. Will they stop again, or they'll continue to focus on inflation? So my worry is mainly on these uncertainties. Probably we'll get more clarity by the second half of this year. And till that time, we'll try to be conservative despite getting better valuation, because in fixed income space, you don't get many chances. Once you get a hit, it can take long to recover. So it's better to play conservative and try to build a stable portfolio and deliver a stable return than speculating on in this environment. So we are defensively positioned again in highly liquid government securities and PSUs, and low duration, investing in very short-term bonds, keeping some cash. When I say cash, this is not zero return cash. We are deploying it in traps or T-bills where we are getting some return. So it's a conservative position in the dynamic bond fund. And again, a word of caution: if investor investing in dynamic bond fund, though we are taking a cautious approach and trying to keep it safe, if you are investing in dynamic bond fund, make sure you have a long holding period. Right?
Thanks, Pankaj, for adding that also. Yeah. So this is a question for you. What are your views on SEBI's passive ELSS funds?
Yeah, so I had a few read-throughs on what SEBI is telling about passive ELSS scheme. One, I think they are not allowing to have both passive and active. And if my understanding is correct, most of the mutual funds already have an ELSS. And since these are lock-in funds, I don't think so. They can be merged with some other funds, or can be moved out from ELSS bracket. So if any fund wants to switch over to an ELSS passive, they have to wait for 3 years, wind down the fund, stop taking money right now. And that's the only way. So that's one bottleneck of having a lot of passive ELSS schemes available for the investors. Second, what I saw through was that the passive index that passive ELSS can replicate quite a few indices. So I'm not sure as a category how will they be benchmarked and compared when they are when they are replicating different indices. So one can, I think, be a replica or a passive take on Sensex. Another one can be on maybe BSE 200, and that's what my understanding. So that is also a challenge that will be. And ELSS as a category, if you look at it from that perspective, it gives you, since it's a lock-in fund, it's a 3-year lock-in fund, it's a relatively stable AUM of money that the fund manager manages without a lot of pressure on redemptions and money moving in or out. Plus, it is still a very flexi cap fund, in the sense that it does not have SEBI caps of having 65% large caps or 35% or whatever SEBI caps on different categories are. So it's a true really flexi cap fund where the fund manager can take a call on business and hold it for long term. And if you look at longer term, category returns have been higher than benchmarks. So I think even the active funds are doing very well. And as we have always told, that there is an opportunity for active return alpha generators in India still, though passive is coming up fast and how. But even active returns can generate reasonable good amount of returns net of fees. So a lot of opportunity for ELSS active funds as well. So it will take some time before things evolve, and we have a lot of ELSS passive funds to compare with. Maybe some newcomer AMCs who do not have this product, ELSS active product, will be launching a few passives. That is a possibility, but I have to see how are they compared with and how things shape up from here. So yeah, that's the broad view, broad understanding that I could gather in few days of the circular.
One more question for you. There's an investor with Quantum long-term equity fund. Now there's an April-May season for office goers. It's an appraisal time. So he has an appraisal now. So what should he do? Should he up his SIP in Quantum long-term equity fund, or what should he do with the extra income right now, what he's generating or getting?
Look, so SIPs are always a very great vehicle and a very good approach of investing. It's a staggered approach. If you look at I'll just give you an anecdote. So if you were an investor in January 2008, when market touched a high of that cycle, 20,000 index, and held it for 10 years or 11 years, you generated a return of maybe 9-10%. Same year when the market crashed because of Lehman crisis, if you had invested at the bottom, you generated close to 19% CAGR in the next 10 years. But my suggestion to investors is either of the things one should avoid. It's difficult to catch the bottom, and one should try to catch the top as well. So the best approach is a staggered approach. So if one had taken an SIP route and done an SIP from Jan to maybe an October period that year, you would have generated 13.5, 14% return. At 14.5%, your money doubles at 4.5 years. And in 10 years, you would have quadrupled your money 4 times. Like, so 1 lakh rupees invested would be like 4 lakh rupees in next 10 years. So I think a SIP approach is great. If you have a great appraisal, congratulations to you. If you have extra income, definitely you need to deploy that to equities for that growth approach. But don't miss out on that 12, 20, 80 asset allocation. If you have gaps in equity, SIP is a great approach to invest into. Quantum long-term equity value fund, with the value coming back in favor, should do well and should benefit in this environment.
Thanks for it. Ghazal, this is a question for you. We are showing 20% allocation in gold also, and we have talked about gold also, that how gold is important for your allocation. But we being Indians, that we already have inherited gold, which is in our lockers, which is in our bank lockers also. Yeah, there is physical gold which we wear. So, and there is a certain ETF gold that we buy. So all put together, what should be my gold allocation?
Yeah, thanks, Sandeep. So when we say 20% of your investment portfolio should go to gold, that would include, say, if you're talking about physical gold, maybe coins and bars, apart from financial avenues like gold ETFs and mutual funds. But the gold that we wear or consume, like jewelry, will not be part of this 20%, because it is very important that you differentiate between gold that is used for consumption and gold that is, that you're allocated to for investment purposes, right? So, and so that is the first part of the question. Secondly, within that 20%, like I already mentioned, financial avenues like gold ETFs and gold mutual funds can be a good option because of the various benefits they bring to the table in terms of there are no purity concerns, they're extremely price efficient, extremely liquid, well regulated. So all of this should have a bearing. These things should be taken into consideration when you choose an investment vehicle for your gold allocation. And anywhere between 15 to 20% of gold can effectively reduce risk without sacrificing returns. And so a strategic allocation, in line with the 12, 20, 80 allocation that we've suggested is what we recommend.
Thanks, Ghazal. Chirag, this is a question of fund of fund again. Yeah. Now fund of fund invest into other funds. So obviously there will be an inheritance cost of the underlying funds and what quantum mutual fund charges. So we charge around 0.51 on that. So as an investor, can an investor first thing, should he go and directly invest into those funds? One, and secondly, also you can brief our investors that what is the amount of research, what is the time, and how he can be benefited by investing into fund of fund, and also allocating that 0.51 cost. Is it?
Yeah, so there is a dual charges. I agree with that. There is a 0.51 cost on over and above the direct plans that we invest into. So firstly, we are investing direct in direct plans. There is a cost to research. There is a cost to have a team that kind of gives you that research-backed allocations, and therefore there will be some cost attached to it. What if you invest on your own? Whenever you churn funds, you pay taxes on them. But whenever we as a mutual fund, given we are pass-through vehicles, when we change funds, there is no tax element that comes to you. Plus, from a say you make an investment and you don't know when to exit. Yeah, you may find a great fund, but if there are any red flags that come along with them over a period of time, then taking those calls of knowing when to exit that fund is usually, we have found, is difficult for investors. And the biggest thing that we bring to the table, apart from doing the number crunching, looking at qualitative aspect, portfolio characteristics of the fund, valuation of the fund, etc., we go and meet the fund manager, look at their processes, look at their succession planning, etc., whether that is in place or not. Look at the philosophy of the fund house, and basis that we make those investments. So we do not make any investment without meeting the underlying fund manager. We try to assess, ask them hard questions. We try to identify if there are any red flags, and if there are, we do not invest with those managers. So doing on your own may have those risks attached, which kind of minimize when we do investment on your behalf. And given the tax efficiency, given the research-backed process, given the process we have in terms of evaluating the fund managers by meeting them, I think that gives you an edge over direct investing. Because usually investors invest by looking at the past performance. And that's very, very dangerous because what we have seen, given the consistency in the mutual fund landscape, what's top today does not remain top, and you will end up investing in the wrong funds. That is what we try to avoid and choose consistent performers over the top performers, thereby giving you long-term risk-adjusted returns. Usually, rankings that you see are usually based on returns, and we do a risk analysis as well and trying to safeguard in a way and minimize the errors that you make while investing. So if you think there is merit to get this research-backed allocation, there is a tax efficiency attached with it, and that comes at a nominal cost to you. So I think it's upon your good judgment, whether this price that you pay of 0.51% for the advice, for the recommendations, and for the convenience that you get, because it's just one investment that you make and you're diversified across different styles, and you don't have to worry about monitoring those funds, investing more money when you have in those funds. You just make one investment, one monitoring, and you are through with your investment. So I think there are enough merits when it comes to investing in the equity fund of funds. Globally, it's been a very popular investment through which individuals invest into mutual funds. And I think it will grow in India as investors understand the merits over a period of time.
Chirag, also there are. Can you just go on the slide on the asset allocation returns, and can you just brief the or
Sure.
just on that?
Sure. Given the 80-20 strategy, if you look at the returns here, right, 14.89, or if you look at even the individual fund returns, this metric is based on monthly return series, and monthly returns are kind of compounded to arrive at the CAGR returns, compounded annualized returns. So when it comes to comparing this with fact sheet, there could be minimal differences between what you see here and what you see in fact sheet, because fact sheets are based on daily data sets. And this is based on monthly data sets involving also on the strategy. Of course, there will be rebalancing elements as well. But on the fund returns, given the difference in time that is used, monthly versus daily, there could be small differences between the two, but those differences will be small. So, if there are any differences, you could tell us, we can explain that to you. But majorly, the difference will be on account of the difference in way it is calculated. Second is, when we talked about the 12-20-80 strategy, our core message is that you need to diversify across asset classes and within asset classes. So some investors may think that 80% allocation may be high for equities, or the 12 months of safe expenses could be very small. So this can be customized. You can evolve your own strategy with which you're comfortable with, but at the end of the day, you need to diversify across asset classes. That's the core message we want to leave with you. So 12-20-80 is a base allocation. You can adjust it based on how comfortable with you are, given the life stage you are, the cash flows you have. Based on that, you can customize it. Even our dashboard on our website allows you to customize this 12-20-80. It's not that you have to go along with this. You may increase this 12 months to 24 months, 36 months. You can reduce the allocation from equities to 70%, or even increase it if you're young to 90%. And gold could be 10%, 15%, 20%, depending on how you want your portfolio to be. But it is necessary to have an emergency corpus. It is important to have gold in your portfolio, and it is important to have allocation, a higher allocation to equities to benefit from the long-term growth story that India offers. And this kind of diversification adjusted to your own circumstances will help you achieve your financial goals.
So one more question on this, again on the asset allocation only. When we are suggesting 12-20-80, we have a multi-asset fund, we have a bond fund, we also have a bond fund. those funds do not make way to your asset allocations. So Chirag, your views on it.
So of course, the gold fund is part of it. Dynamic bond fund, because we think that many investors do not understand the risk associated with a dynamic bond fund. They kind of treat it as a replacement to fixed deposits. Fixed deposits give you guaranteed returns. In a bond fund, you can even have negative returns. Like if you see over the last 1 month, bond funds have had negative returns. So if you understand that well, then you could look at venturing into that. But otherwise, if you can keep it simple, keep liquid fund exposure, which does not take any credit risk, and have that allocation, high allocation to equities and some allocation to gold, I think that will help you solve the purpose. So if you invest, if you don't understand an investment or a fund or a asset market, then don't invest in that. Invest wherever which things that you invest can easily understand. And this simple allocation, as we have shown, a compounded annual returns of 14.9% after expenses. It's a great return for you to achieve or reach your financial goals. And if that simple thing helps you achieve that, then why get into complex things which you may not understand and fall into traps of making that wrong investment call. So that is why we have not included. We wanted to keep it simple. We wanted all investors to understand that and invest and build their portfolios over a period of time. And that is why we have not kept into it. But if you understand that, you can have some allocation to that as well.
So Chirag, also multi-asset is not a part of it. Can you explain to our investors why you should look at multi-asset as a fund?
Yeah, so multi-asset is a fund where we invest into equity, debt, and gold. There we kind of dynamically allocate depending on the attractiveness of that asset class. The idea or the concept of that fund is very, very simple. Most people have huge amounts allocated to fixed deposits, which are a losing proposition for investors. And if you want a market-linked alternative to your fixed deposits, which takes slightly higher risk and gives you better returns over a period of time, or endeavors to give you a better return over those what's offered by fixed deposits, then that is the fund to be. So we will dynamically allocate to equities, debt, and gold, and try to achieve that higher return while taking those minimal risk when it comes to investing. Of course, FDs are safe, guaranteed instruments. There we have seen many times that even banks have gone belly up. So it will depend on what kind of safety you want to be in. But again, if you're looking for a market-linked alternative and have that higher horizon of more than 3 years, then probably you can look at multi-asset fund as an alternative. 2080 strategy is a very long-term diversification strategy. And that is where if you have, want to build wealth for the long term, which you are not going to touch for 10, 20 years, then the 2080 strategy is the place to be. But if you're looking for alternatives to fixed deposits, etc., then the multi-asset comes into the picture. So very different objectives of both the strategies, 2080 and multi-asset. Multi-asset is a solution package offered which will allocate across different asset classes. Whereas 2080 is a do-it-yourself DIY strategy where you kind of build your own portfolio and which is meant for that long-term wealth creation for you. So objectives are very, very different. And if you think if you're looking for long-term, then 2080. If you're looking for 3, 5, 7 years horizon and want to not take excess risk, but slightly higher risk and want a better return than a fixed deposits, probably you can go to the multi-asset fund. So above 3 years, also multi-asset funds become more efficient than your fixed deposit. They are taxed like a debt fund. And FDs, if you're in a high income bracket, the FDs will be taxed, or returns from FDs will be taxed at 30%. For a multi-asset fund above 3 years, it is taxed 20% with indexation. So your tax will somewhere come between 8 to 12% kind of range. And that becomes a significantly lesser tax as compared to 30% with fixed deposits versus 8 to 12% in the multi-asset fund. So multi-asset fund also tax efficient in that sense. And whenever we change allocations in the multi-asset fund, again, there is no tax that the investor has to pay.
Thanks, Chirag, for this. Yeah, we would like to. There were some questions we got on the email. After this webinar, also you can still write to us on customer@quantumemc.com if any questions you would like to get answered from us. Before calling off, Chirag, Pankaj, Ghazal, Saurabh, what would be that one thing you would like to tell our investors? Yeah, Saurabh, you can start.
Yeah, so maybe I'll go first.
Yeah.
So what we are seeing around us is the increase in noise. If you go back 15, 20 years, maybe there was one TV news channel and maybe one or two newspapers that come to your house, and that was good enough to disarray you from your long-term goals. And now you have plethora of 20, 25 channels shouting at the top of your voice, and you have multiple media resources, you have social media. All of these things, all of these make enough noise for people to be myopic in their investment and decision making. So it is extremely important that you be anchored to some longer term goals that you have, and you have a good asset allocation strategy. And that asset allocation strategy that we have been talking about, 12-20-80, does exactly that. Sticking to that strategy will ensure that you achieve your financial goals, will help you steer clear of all that noise that goes around you across speculative things that have come up now, or some other asset classes that are showcased as asset classes and have seen very good returns maybe in 6 months, 1 year time. But having a little more longer term approach and not having a myopic approach is extremely important. So please anchor your thoughts to your asset allocation, and that will help you achieve financial goals, and don't get deceived by the noise around you. That would be my kind of few words to our investors. Thank you.
Sorry, Saurabh, I was not going to take any questions, but it is coming forward since you spoke about the noise about. So as investors are looking to choose funds out of those vast number of funds, there are also a major number of AMCs also. So how do people look at AMCs? And what are the prospects for AMCs in the market? Are they are they going down like state insurance companies like GIC or LIC?
Look, so if this view is more of an equity investment into AMCs, one thing we are very clear about as that if you look at the percentage of equity investment that Indian household does as a part of their savings or financial savings, it's still very, very small. So equity savings will increase as people get more understanding of equities as an asset class and not as a speculative class. So there's a great opportunity for AMCs going forward. Very well managed business in a growing field is definitely a great opportunity. But yes, governance and other aspects become extremely important. Yeah. So whenever you're looking at AMCs, there are 4 P's that are very, very important. That is the philosophy, process, people, and then accumulation of that is the performance. So keep those things in mind and steer clear of noise. There will be enough distractions in terms of what being sold to you and what's being told to you, but you have to believe who's been true to you, and where the disclosure standards are good, governance standards are good, and who is fair in the game. So I think those are the things when you are trying to select as an AMC for investment, both from an equity investment perspective and an investment through an SIP route, and betting on or you're looking for an AMCs for mutual fund investment. So I'm trying to answer both the questions, both as an equity investment because quite a few AMCs are listed. So I'm not sure the question was towards investment as a direct equity into AMC stocks, or the question was selecting an AMC for mutual fund investment. But the answer remains the same. 4 P's are extremely important. People, process, philosophy, and accumulation of that is performance. And there is a great opportunity for AMCs. They have to be fair to their investors, and that will ensure that all stakeholders benefit. Investors in AMC will benefit, both mutual fund investors and equity investors. So it's a long-term game. One need not be myopic. Both investors and the AMC companies need not be myopic about this opportunity.
Thanks, sir. Yeah, Pankaj, any questions for our investors, or one thing that you would like to take away?
Yeah, I think the the main part would be keep your focus on the objective or the role, especially for the fixed income. What role does the fixed income play in your portfolio? So we have seen when yields are down, returns are not good, or FD rates are low, investors tend to venture out in various kind of speculative adventures where just to enhance their yield. So that hunt for yield has never played in favor of investor. We have seen that after, so we had a demonetization when deposit rates were cut to many-year low, and many investors started going after credit funds. You can see we have presented that in past. And we know how that turned out when default season started after 2018. So there are some structural issues with many of the fixed income assets, especially at the lower grade credit. And that will not go away whether economy is doing good or bad. And things can turn very quickly. So it's better to focus on the stability aspect of the fixed income. The idea is to get stability in your portfolio, have liquidity in your portfolio. And I think you just focus on those objectives, and maybe there will be a period where you have to live with slightly lower return. But in past, we have seen that if you remain invested, returns tend to normalize. So you will be tested with lower return for some time, but I think you can ride through that. So be focused on your objective.
Thanks, Pankaj. Ghazal, what would you like to recommend to our investors, or what would you like to advise our investors?
I think on this webinar today, we've discussed a lot of nitty-gritties and the details of inflation and monetary policy, etc. But I think if one word describes the current, macroeconomic and financial environment, it is uncertainty. And every time equity markets or risk assets tend to do well, investors tend to discount diversification, asset allocation, gold utility in a portfolio, and then they come running back to gold or other portfolio diversifiers and keep coming back to diversification when risk assets take a hit. So, I mean, my message to investors would be that uncertainty is the only certainty. I mean, over the last 2 years itself, we've seen so much happen, to the global economy as well as domestic front. So I would say diversification and asset allocation. This should be the mantra always.
Thanks, Ghazal. Chirag, your comment. Before that, we had a suggestion from one of our investors. This is Mr. Madhusudan. Now, the suggestion was that we at Quantum are not talking much about SWP, that is systematic withdrawal plan, and this can be highly used by people who can look at Quantum mutual fund as for a pension. In fact, thanks for that suggestion. We will next time surely make sure that we will talk about the SWP option, and we really appreciate that you are trusting us with the pension. Thanks a lot for that. Over to you, Chirag, your final comments.
Sure, thanks, Sandeep. The thing is simple, right? What Ghazal also said, that biggest increases in gold demand that we saw was in 2008 and in 2020. After a crisis stucks, everyone kind of comes to the safety of gold, and that is similar trend we have seen. After equity markets start doing well, people flock to equities, chasing the returns from equities. So don't do that. I think that kind of minimizes the probability of you earning a better return. Just keep investing, diversify yourself, keep it simple. Today, I mean, everyone wants your wallet share. Do educate yourself, see what is good for you. If you don't understand anything, don't invest in those things. Simple way to achieve your goal, financial goal, is to invest in a 12, 20, 80, or that could be a base allocation. You can modify it. There are tools available today to make your investment journey simple. Come to our website, try it. It is indeed very, very simple. So if you're not happy with 12, you want to make it 18, you can just change the numbers and you get the rest of the asset allocation, how it's going to look like. So just keep it simple. Diversify is the mantra. Diversification should be a core of anything that you do. Don't just rush into chasing returns, because that is the last thing that you can do to impact your long-term wealth. Just keep investing. SIP is a great way to invest. Invest in this 12, 20, 80 or any asset allocation you believe will work, but asset allocate, diversify, and keep it simple. That is what I will say. And your investment journey will be very, very easy, and you will reach the intended goals that where you want to go to. So that is what I will say. Just remember the magic formula of 12, 20, 80, and keep investing periodically. And don't try to time the markets. I think it's a futile exercise. You will not be able to catch the top, and you will not be able to get the bottom. So keep investing, do SIP, and keep it simple. Thank you.
Thanks, Chirag. Thanks a lot. Thanks, Pankaj. Thanks, Saurabh. Thanks, Ghazal, for all the useful information. Thank you all for attending this webinar. It's a real pleasure to have you all people. If you would like to get some questions answered from our fund managers, please feel free to write it at customercare@quantumemc.com. Or if you would like to get some new topics covered from us or in the next webinars also, so please feel free to write to us, to our relationship manager, or get in touch for us. Yeah, the asset allocation tool is live on Invest Online section. You can always log into it and do your asset allocation there. Yeah, thanks a lot. Thanks a lot for giving your time. Thanks a lot, Chirag, Pankaj, Ghazal. Thanks a lot.
Thank you.
Thank you, everyone.
Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.